Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Craig Hemke and we're going to be talking precious metals as we usually do. And Craig, I first want to start with kind of recapping the last, let's say, 9 months of precious metals moves, gold and silver, going back to the tail end of last year when gold finally broke up briefly and made the all-time high and then moved mostly sideways, and also what happened in March 1st, right when the calendar turned months. Gold started moving, silver started moving. Silver kind of followed and leveraged lots of gold's move. Now gold right back close to all-time highs. Silver back above $30, a fair bit away from all-time highs, but at least both have that upward momentum now. Craig, how are you comparing, contrasting, and viewing those moves? Buy gold and silver almost in tandem over those last, let's say, 9 months.
Well, I'm glad you brought that up, Corey. It seems like it's only been 9 months, right? Going back to it was right after the war really got going in the Middle East, around that first weekend of October, that gold began its breakout, and it started all the way back at 1800 or so. I think we were 1820. So you go forward to a high here of north of 2400. That's 30% rally in 9 months. And again, that's enough that you're like, wow, that's quite a move. That's a significant move. So you can see why, we've been kind of churning sideways now for maybe 2 months, digesting all of that. And even with what, we had really strong rally Wednesday and Friday of last week here in the US, we still haven't really broken out. We haven't even gotten really not even that close to breaking out yet in either gold or silver. But that may be about to change. We are entering into a time of year that historically is pretty good. We'll call it seasonally pretty good for gold, and then by extension for silver. This late July, August time of year, excuse me, is typically about the second strongest of the year after January and February. So we're getting into a period now where things might surprise people to the upside. You mentioned too, Corey, that how things are similar in silver versus gold. I invite anybody to pull up maybe a weekly chart of you can use the spot price if you want, of gold. And everybody remembers blasting higher this time 4 years ago and then going sideways in gold for about 3.5 years, with maybe $2,000 as the top and maybe $1,600 as the bottom. Well, we started banging up against 2,000 in October of last year, and then finally closed above 2,000 on a monthly basis in November, and then on a quarterly basis above 2,000, confirming that breakout in December. Long-term charts is what really get attention of the hedge funds and the family offices and people that maybe don't have any allocation to gold. That's the type of thing. Those are long secular trends, long secular breakouts that get their attention. And look what happened. We got into the first quarter, gold kind of churned sideways through January and February. Then we all know what happened. 20% rally in March and April. Okay, so now look at that same chart of silver. And as you mentioned, Corey, it's not back to its all-time highs. However, we broke out of silver's been in the same kind of range like gold from this time in 2020 until just recently, between about 21 and 28. Finally got above 28 on a monthly basis back in May, and then closed on a quarterly basis at the highest levels in 11 and a half years, just last week at the end of June. So is silver now in the same spot that gold was back at the end of last year? Is silver going to get the same level of attention on those long-term charts? Wow, look at that breakout above 28, 29 and into 30. So could silver now in this next quarter shine like gold did, at the end of the first quarter and the beginning of the second quarter of this year with that same kind of breakout? That's the kind of thing that has my attention here as July begins.
Man, Craig, I'm so glad you covered that, because when we were covering that move in the end of last year in November, and it made that monthly close above 2,000, and then the all-time highest quarterly close and annual close in December, that really was the shot across the bow that the bull market was in full gear. And a lot of people were still skeptical at that point in time with gold, only to see it a couple months later, like you say, finally lift off. So if that same thing is happening with silver, do you have any targets of where you think silver could go if it's finally now signaled the same kind of thing, a breakout on the monthly and quarterlies, and now finally ready for liftoff? Do you think there's enough impetus everybody wants to know to finally get up and test that all-time high around $49, $50 again, or do we need more work to do?
Well, we're going to take it in stages like COMEX silver futures always seem to do, kind of 2 steps forward, 1 step back. That's why, and I know we've joked about this over the last couple of months, this whole to the moon, silver going to 45 in the next 3 weeks, that kind of stuff. It just doesn't work that way. So it's always, as long as we're pricing things off of futures trading, it's probably always going to move in the stair-step pattern. Turning back, and we're again relating this to gold got above on a monthly close at the end of November last year, got above 2,000 finally. And so it was breaking out. It took 13 weeks, all of December, all of January, and all of February, kind of working down. Think of like almost like a little triangle-shaped wedge, working down, holding that 2,000 level, which had been resistance. It now became support. And then it just blasted higher, like I said, by 20%, maybe a little more than 20%, from 2,000 up to 2,450 or wherever we peaked out. So now silver, again, got out of its range 7 weeks ago. Isn't that crazy? It's already been that long, since the middle of May. And it has been now kind of working in its own little wedge pattern. I mean, I don't know. Is it going to take another 6 weeks for it to break out? Let's just say it does. I mean, that would put us into August, into that seasonal period of strength that then, okay, you break out. What if silver went 20% from here? That would take it from, again, 29 up to 35, 36. That is really does line up well for resistance that you might expect. If you look at the monthly chart, you can go back and see where 35 and 36 would be expected resistance from here. So that's the kind of move I would expect when we break out. Something up to that level before pausing again on that 2 steps forward, 1 step back pattern. What would drive that? And again, this is probably going to need falling dollar index, maybe a increase of rate cut expectations, driving the dollar lower, driving nominal interest rates lower, that kind of thing. And that's where all these economic pieces start to maybe fit together. The jobs report, the unemployment rate, some of these the PMI numbers that we got last week showing the U.S. economy dramatically slowing in June. You can kind of see where the economic pieces would fit together to drive maybe some speculation about monetary policy and future loosening, and how that could then drive the dollar lower, which could then finally break the metals out higher for this next extension of the rally.
Well, that comes all back to investment demand, right? Because we keep hearing about how much central banks are buying gold, but silver's a different story. They're not buying silver, and quite frankly, we're still seeing relatively low volumes on some of the ETFs and even some outflows on some of the ETFs in the Western world. Cycle this all around to that investment demand then, Craig, and if you're seeing a much renewed investor interest in these metals, or if it still is kind of that gold breakout and then silver following.
Yeah, investor interest in the metals, kind of cuts both ways. Whether we're talking about physical metal, you get this Silver Institute numbers that show what are we going to about over the last 4 years, this year included, so 21, 22, 23, 24, running about a cumulative 700 million ounce supply deficit. And that's without much investment demand. So you kind of got that, I don't know, nudging price higher, price having to acknowledge that. But at the end of the day, we're still talking about futures pricing, and you got to have demand for the futures contract, more demand than there is supply, or more people willing to buy those things, expecting prices to go higher. And that's what I'm getting at with the longer term chart and these family offices, the hedge funds, is billion-dollar accounts. $1 billion to $10 billion to $20 billion that they manage going. That chart of silver looks pretty interesting. And I've read some stuff about commodities outperforming equities and that secular trend. And now look at silver. Maybe we ought to take a position in silver. And then what do? They buy COMEX futures or something else like that. So there are, like I said, there's kind of two different edges to the price. I think investment demand as a function of physical demand and how that might widen that supply deficit can float things up from the bottom, but that breakout that everybody sees in a traditional sense in price can kind of drive that futures price higher too.
Well, Craig, I'm wondering if you've noticed that there's been a narrative around the shift from investment demand in both gold and silver from the West to the East. Obviously, there's a lot of action there, and it's not just China. There's a lot of silver buying and gold buying from India. There's a lot from Vietnam. There's a lot in Thailand. there is a lot in Russia. And so there's a lot of Asian demand in general for the precious metals. Sometimes I think we get a little myopic on just looking at what the US demand is or what Canadian demand is. But if the East keeps fueling this move higher, is it possible that the West just has to play catch up with what the East is dictating as far as the price they'll pay for these metals?
Well, I guess I might use that to kind of segue off to this whole Shanghai versus COMEX argument, right? We're seeing, even as we record this, excuse me, about 11 to 12% premium in the Shanghai price for silver versus the price that is traded on COMEX. And you wonder why that is and why that persists. What is the actual price? Is it what is essentially a physical price in Shanghai, or what is essentially a paper price in New York? That kind of, I don't know, like I said, it's kind of an offshoot of what you asked, Shad, about physical demand, especially in the East, impacting price. I'll be very curious to see which side eventually wins, and maybe that's the wrong way to put it. I don't know, but that premium isn't easily arbitraged, as we now know, because it's persisted now for several months. Again, the idea that premiums like that shouldn't exist because of arbitrage, meaning that you should be able to look at that and go, well, hey, I'll just, you know what I'll do? I'll buy in New York and I'll sell in Shanghai. And that buying here and selling there should have this combined effect of narrowing that premium back down to maybe 1 or 2%, but it hasn't happened. And again, I would probably tell you, at least my idea is, there's a reason for that. One, it's logistically not that simple. And two, if you are selling in Shanghai, you're making a promise to deliver in Shanghai. So the buy side of that trade is you're buying in New York or in London, and you're going to have to make the assumption that they are going to deliver to you so that then you can further deliver in Shanghai. And there's clearly not a whole lot of people that are confident enough to make that trade. Because at the end of the day, if you don't get your delivery, you're going to be short in Shanghai. And it sounds like the title of Hangover Part 4, actually, short in Shanghai. But something like that might happen to you if you end up short in Shanghai. And so that premium persists, and it'll be interesting to see what wins out, that physical demand you mentioned in the East or the paper supply in the West.
How does this all relate to the underlying stocks then? Because I think we do focus on North American demand, especially out of the U.S., because, well, that's the investing market that funds these companies. Are they coming around to it? Have you noticed life in the underlying stocks?
Yeah, they all look very interesting. The chart of the GDX, if you want to use that as a proxy, is pressing right up against resistance that goes back to the highs of 2011. So talk about a breakout that might get some attention. You get GDX soaring up through 37 and 38 and staying there for a while. That could shift some, again, for these big amounts of money that are out there that are managed by people that are looking for secular trends, long-term secular trends. All of a sudden, the GDX starts moving up back toward 40, and you can look at that chart and go, well, look, that's clearly broken out of a 13-year trend, 13-year little pennant pattern. That can start to feed on itself as well. Now we're getting into, by the end of this month, July, and into early August, we'll start getting production results and earnings guidance and then earnings results and that kind of stuff. This should have been a pretty good quarter for producers. Now, at the same time, we thought the first quarter should have been a pretty good quarter too, right? Coming out of how things traded then, or the fourth quarter of last year should have been a good quarter. And again, prices are only marginally higher. So maybe if we can get that breakout on the chart, get more people interested in the sector, get more people interested in what is perceived to be maybe more value than growth, all those things might kind of combine to finally get the stocks to move up to levels that we kind of would expect to see at gold 2400.
Yeah, Craig, it's going to be interesting to follow along with the Q2 earnings to see if there was a bigger spread. That the metals prices are notably higher, though, than they were in the fourth quarter and first quarter as an average price. So it should bode well for gold and silver producers. But you mentioned earlier about looking at the economic factors that could line up with some of the technical and seasonal factors. Let's connect the dots here and look at some of the other economic factors that you have on your radar in the weeks to come.
Well, it's going to be an interesting week. Again, now we're getting to the second week of July. Again, with that breakout, that right there on the monthly and the quarterly chart in silver. Look, what did silver do last week? Up $2? Pretty good start to the month and to the quarter. But this week now, we've got some different waters we've got to navigate. We're recording this here on Monday the 8th. Tuesday the 9th, we get Chief Jerry Powell back on Capitol Hill. Here in the U.S., there's I don't know what it's called. It's not a law. It's a regular, whatever it is, that was passed years ago called the Humphrey-Hawkins Act that demands that the head of the Fed come up twice a year and testify in front of the Senate Banking Committee and the House Financial Services Committee and let them know how things are going. So anyway, Jerry's going to do that Tuesday and then Wednesday of this week. So expect volatility off of his opening remarks, also off of the question and answer period. So the next couple of days is going to be volatile. And then, oh, holy cow, here we go again. Thursday brings the latest CPI report, Consumer Price Index, and Friday the PPI. So we got a lot going on this week that is going to impact prices, no doubt about it. Again, I don't know if we're ready to break out yet. Obviously, gold's got a good maybe $100 to go before it breaks out of the top of its consolidation range. Silver's got a good $1.50 maybe. So, but we might at least begin moving higher toward the top, setting up that breakout again as we move into a seasonally strong period in the late stages of this month and then all through August.
All right, Craig, always good chatting with you. Thanks for breaking down what you're seeing in the metals, what some of the next catalysts might be, and comparing what we've seen just over the last little less than a year. We'll chat with you again next week. I hope you have a great rest of your week.
Thanks, guys.